Well, good morning, everybody. Thank you for joining us. We're a little bit earlier this morning because we're teaching a class first thing this morning. So our backstory starts just a little bit earlier. So my name is Alan Richardson. I'm the managing broker here at Maximum Realty and Realtor Partners.
My name is Richardson, a compliance broker for Maximum One Realty and Realtor Partners.
And short stuff is what she is. And so every week we kind of go over the comings and goings and what's kind of happening in the real estate world. And we kind of want to start off with that. If you keep up with the news, it seems like when it comes to real estate information and news, it's dark clouds and doom and gloom. And this, our market has shifted from the perception side of point of view, much more so than the reality. And so it kind of starts off with like, first of all, the market is not so bad, right? By historical standards, our market is still hot. We're still in a seller's market kind of thing. It only kind of looks off when you compare it to 2021, but 2021 was an outlier. It wasn't normal. It didn't follow in normal patterns, that our post-COVID, bump that we got. That's what we're going up against. But, comparing us to pre-COVID times, we're actually doing really, really good on that. So in addition, supply remains really, really tight. See, for residential real estate, it is tied to supply, the basic loss of supply versus demand. And so, yes, we have less demand right now, but guess what else? We have a lot less
supplies.
We have a lot less supplies kind of thing. And so, even though some of the forecasts really aren't that bearish when it comes to that kind of thing, like what we're going to talk about the mortgage brokers here in just a minute, and they're looking at overall mortgage originations dropping, but when you really break down the numbers, it's not really that bad kind of thing. And so we kind of got to understand that. On the other hand, we are looking at some point here, as soon as inflation comes under control and the Fed is working hard, that's the only thing the Fed seems to care about right now. And so as inflation comes down, we are going to start seeing lower interest rates once that starts happening. Until that happens, I don't think that we're going to see any kind of relief there. We are seeing prices trending down, but we're not seeing dropping property values. What we're seeing is the rate of appreciation is slowing. And so, as the rate of appreciation slows and as interest rates come down, guess what's going to happen to our market? Boom, it's
double whammy, because the demand's still there, and now the seller feel a little more confident about selling their property. Everybody knows, seller knows that the interest rate is really, really high right now. So we have some seller even offering buying down rates for buyers. Yeah.
So right now, what are things that we should be looking at? First of all, this is the best time to build up your sphere of influence. This is the time to be going out. During these kind of times, when there's market uncertainty, below average agents are just going to shove their head in the sand and kind of not really communicate. Their communication is going to go to nothing because they don't know what to say. At the same time, you can be the voice of reason. You can be the person who's building relationships right now. Even if they're not going to buy right now, they are going to buy moving forward kind of thing. So the whole idea that we just need to and we see it, some of this is like seasonal, right? We see this shift every year, Halloween, Thanksgiving, Christmas, this whole holiday season that we're moving into is always a slower time overall in real estate. But that being said, this is also the best time to get back to basics, to start building up your business. And you'll be surprised how much business you can actually generate in there because so many people just kind of phone it in.
And honestly, you guys, it's all about engagement. And you're more than welcome to use any of our slide as a point of expertise in your field, and kind of let everybody know what's going on. And when you do that, guess what? The seller and the buyer is going to look at you and say, she know or he know what he's talking about. And so therefore, when I'm ready, guess who I'm going to be calling? You, the agent.
So it's time to look at where's your business coming from, because for the vast majority of agents, 80% of the business comes from friends and family, people they know, people that know them, that kind of stuff. And so are you engaging with your sphere? And then at the same time, those referrals that are coming from our sphere are so crucially important. If you're not reaching out into your sphere with a phone, then there's no way that you're going to get referrals from your sphere. A lot of agents also have a farm. And whatever kind of farm you have, whether it's a social farm, a geo farm, whatever it is,
or a neighborhood farm.
Yeah, being able to reach out and engage with those. How about open houses? Are you getting any kind of business from open houses, or have you just decided that you're not going to do them?
And let me tell you, I have a listing agent right now hustling out there doing open houses because they know open houses are more for the neighbors around the area that looking at selling or potential buyers.
And then online, guess what? You can do more on Facebook than watch videos of cats with silly hats on, right?
He does that.
Yeah. But that being said, like actually treating our online business as a business and not just as like this social platform where we go and play all the time. Networking, it's time to actually get out and network and work with other business professionals, other realtors, that kind of stuff.
Your realtor membership, your local chamber of commerce, your local sphere influence in business that you travel around with.
Yep. And then, one thing that a lot of agents miss is just those agent to agent referrals. Those are really important pieces.
How many times have you gotten a phone call from an agent that's outside your area and just had a nice conversation? I mean, and if you have a client getting ready to go up to that area, wouldn't you refer that agent? Absolutely, all day. So do network with other folks. So
look at how you're going to build your business. Now's the time to do that. You don't want to be looking back at this kind of thing. So let's kind of jump forward, and I want to kind of share out here with you some of the changes that we see happening. So NAR came out and they issued some new NAR policy changes. And those are now coming into FMLS and Georgia MLS.
Yep.
Thank you, Dana, for pointing these out. And then, several folks have pointed that these are out there. And so we just want to make sure everybody's on the same page with these. So a couple of the new things, and then some are really not new at all. First one is that agents are prohibited from advertising their services for free. We do not work for free. Do you guys have anything of value that was free? No. And so this idea that
sellers pay for it.
Well, who buys the house? The buyer does. And all the costs associated with it. So at the end of the day, the buyer's paying for those services. So please, we can't advertise that our services are free. Now, one of the biggest changes we've seen is that all financial bonuses or incentives must be in public remarks. Used to be, they couldn't be in public remarks. Correct. They must be in private remarks. Now, complete 180, we've done a full switch on there. So any changes to co-op commission? So if I show this house to, if I have to show this house to your buyer, then the commission is reduced to 1 or by 1%. Must be in public remarks now.
And the reason behind this is that when you have a buyer brokerage agreement with X amount percentage, as the buyer needs to pay the buyer's agent. Now, when we send the information out public, exactly what the split commission is, buyer already know upfront if they have to come up with any additional commission that they need to pay prior to closing and prior to contract.
Yeah, and a lot of this comes because all changes to commission or bonuses and incentives must appear in the IDX website's advertising. The IDX advertising does not show private remarks.
Correct.
So this is the big change here. So we got to make sure that we've got our act together here on this. So let's see. Here's our bad news.
Interest rate.
Interest rate. So interest rates now topped 7%. 7.08 is where it came in. So we are seeing where that is, that this is the factor that's really driving our market right now are the interest rates, and it's largely being fueled based on inflation.
Correct.
Because it's causing so much turmoil in the market. Now that doesn't mean that everything is doom and gloom here. So first of all, the share of home buyers applying for an ARM is up quadrupled, right? So what? 400
times.
Yeah, 400% kind of thing. So yes, our 30-year fix came in at 7.08. Our 5-year adjustable rate came in at 5.96, which is a lot more palatable for some folks.
Absolutely.
And so that's a 5-year ARM. You're going to have to refinance, but we feel very confident about the rates are coming down as well. But again, I'm not trying to push people into ARMs. I'm just trying to say that there are options out there for our buyers.
To not get the initial sticker shock. And also, once again, we're projecting interest rate coming down, and this is based on inflation. So if the government can can control the inflation, then the interest rate will come down.
So, there's this headline that just came out, said U.S. mortgage originations to decline 9% in 2023. Dun, dun, dun. But you got to read the fine print. Right, exactly. Purchase originations are forecast to decrease by 3% in 2023. Now, for the vast majority of agents, we're still looking at a 3 to 4% property value increase, which means it's a net wash for most agents on, as far as like what they're bringing home. So yeah, we're looking at less purchase originations moving forward, but we're still looking at property values that while our rate of appreciation is slowing, it's not the same rate of appreciation we've had. This is not like this complete flip-flop market, right?
On a foreclosure. So the 9% decline, the reason being that the other 6% was refined, because there's a lot of people who refied lower than 3% last year. Yeah. And so it's a great deal for them.
Refis are down 25% basically. Right. So refis are going to continue to be until the rates
come the rate, right. Yep. Nobody's going to refi to a much higher interest rate. Not just unthink of.
Yep. So now one other thing that Fannie came out this past week and said that they estimate that mortgage rates will fall to 4.5% in 2023. And boy, will we love
Fannie Mae.
Yeah, Fannie Mae released this, and so this is their estimation that we are looking at mortgage rates that once we get inflation more back in control.
2022, right?
Yeah, I mean, and really what's happened is with our high inflation, the Fed is really raising the federal funds rate, which doesn't raise mortgage rates. What it does is it creates a lot of volatility in the markets. So a lot of people move their money over into treasuries,
which is stable.
Which is a lower return, but very stable. But guess what mortgage rates are? Basically treasuries. And so the more people buy treasuries, the more those rates increase. As the market stabilizes, we're going to see more people pull out of treasuries. What's going to happen with interest rates?
Yeah.
Right. Yeah, that's where we're at. Now, when we talk about, buying and interest rates, I want you to understand that this is what's going on with the median asking rent since 1988. You can see that they are continuing to increase. Rise. And one thing I really wanted to show here is that for a lot of our first-time buyers, we believe that this is a painful time for our first-time buyers. We know it absolutely is, but we also understand, and I want you to understand that that wealth is tied up in home ownership. And so these next two slides that I want to share you here, this is showing the increasing gap in family wealth. So the average wealth for a renter
versus an owner.
In 2010, the average renter net worth was $6,010. In 2013, it went down to $5,900. In 2016, it went down to $2,300. And then it went back up to $6,270 in 2019. At the same time, just the average property owner's net wealth, okay? How much the average, adding up all the property owners in the United States together kind of thing, the average net wealth is $198,000 back in 2010. And then all the way up in 2019, it was $249,000. And now, where does that look like? The average net worth in the United States for homeowners is $254,900. Still, the average net wealth for a renter in the United States, as of right now, is $6,270.
So huge gap.
Well, do you want to be part of the group whose average net worth is $250,000? Or would you like to be part of the group whose average net worth is $6,000?
Well, this
it's really kind of it's such a drastic change in the average American's net worth. And so like we see right now, single family building is slowing down. You know what isn't slowing down? Multifamily, apartments, things like that. And so like investors can go in and capture that net worth. They can capture that value that people would be taking. So yes, are rents rising? Yes. Have interest rates been rising? Absolutely. By the same token, 5 years from now, your average net worth is still going to be $6,000. and approximately that kind of thing. So,
whereas you can accumulate, way beyond that in 5 years. I had actually interesting conversation with a lady who I do business with, and she mentioned that she is going to stay in downtown Atlanta. She loves the Midtown area, and she's going to be there for 5 to 10 years. She said, I'm just going to rent for the next 5 to 10 years. And so I'm like, why would you do that? And she said, what do you mean? I feel like if I want to buy, I want to buy a house. I said, well, have you thought about condos? Because if you go stay in Midtown, have that lifestyle, which is awesome. I said, the thing is that when you get ready to leave, guess what? You already paid 5 to 10 years worth of mortgage. That's something you can capture from buying versus just giving your money away for the next 5 to 10 years. She's like, oh, okay.
Makes sense. Very good. Well, now the US GDP numbers just came out, and so GDP jumped back up. We had 2 consecutive quarters where GDP growth slowed. I really do think that we're going to be moving into Q4 showing negative growth again. And I'm not a recession hawk or bear or any of that kind of stuff, and I'm not an economist. But that being said, like the numbers that came out with the change in GDP is not reflective of what we're really seeing in the market. Right. GDP is largely driven, or what largely drove this was a huge increase in manufacturing and in goods being shipped out versus goods being received. And a lot of other countries, China, that kind of stuff, they really held back, and their manufacturing is way down, whereas the US has really been ramping back up. But if you look at like the housing market, which normally makes up about 25% of the entire GDP, instead it was only about 4%. So we're looking at, as right now, that was a lot of orders that were kind of backfilled and that kind of thing. And I'm not hoping for a recession. I don't mean that by any means. A recession does not mean a housing crash. First of all, let's make sure that we understand that.
Because at the end of the day,
our economy's still rolling.
Yeah, you still got to have roof over your head.
Yep.
Okay. So these houses still remain.
Yeah. So another interesting headline, the S&P CORELOGIC CASE-SHILLER index continued to decelerate in August. It sounds like a horrible number, like it's decelerating.
It's mouthful.
That means that, here in the Atlanta market, we were only 20% up over prior year. Yeah, I just wanted that kind of sink in for a little bit. Yes, okay. So our rate of appreciation is not as great. So we are decelerating, but we're not below last year. We're still significantly higher than last year.
And you got to look at where's your basis of those numbers when it's being published in the news, because the basis can be last year or last month, because you just can't have a continued growth every month and not expect it to decrease at some point. And that decrease does not extend to what the prior month or prior year numbers are. It's still above.
Now, our pending home sales, those are, pending home sales are down about 8% month over month. We've seen that kind of significantly. Here in the South, we actually have a much lower rate than other parts of the US. The Sun Belt is still really, really strong. This is what it kind of looks like on the national scale as far as pending home sales. We know that pending home sales has largely been driven, by the demand is being curtailed by our mortgage rates. That being said, the number of homes for sale on market are still lower. What about showings though? So we went ahead and pulled up the showing time index. And so the showing time index, it shows, right now, the number of showings here in the South is down 27%.
Correct.
And that seems really, really scary until you actually look at the numbers and say, guess what? We're higher than we were pre-pandemic.
Correct.
So yes, we know that we are not where we were last year, and no one's trying to, like I'm not trying to blow smoke up your skirts kind of thing.
Well, last year interest rate was awesome. So, people were buying left and right.
But, what we're moving into is that, yes, they are down from last year. We're still over where we were before the pandemic hit. Like if we hadn't had the last 2.5 years, we'd be like, hey, things are going pretty good. Instead of having this feeling of doom and gloom, woe is me, that kind of thing. So we are seeing a lot more signs of the market is balancing. So, you know, National Association of Realtors, they put out some studies or polled realtors out there. And so we're seeing where the buyers who waive contingencies, buyers who waive appraisal contingencies, financing contingencies, inspections are all dropping. We're seeing, and I think that's a good thing. I don't want buyers to waive any of their contingencies. I don't think there's a need for that. We are seeing where, you know, there's more of a shift moving people are moving into suburban, small town, rural, that kind of thing. So we're seeing more people still continuing to move out of the city. You know, we're seeing a lower percentage than we were before. Last year, the number of people that were looking for work at home was about half of our buyers, and now it's about a third. And so that's still a significant number. It's just nowhere near where that is. And so, you know, those are kind of some of the biggies in there that we just kind of want to share.
And there's a lot of, there is slight uptick on a percentage contract that was terminated within 3 months.
We're going to go there in just a second.
Okay.
So I'm just going to kind of cut you off there. Hold on one second.
No worries.
Yep. So, you know, Glenmede, who's a huge financial advising company kind of thing, they said, listen, you know, the current housing market downturn is significantly different from the 2008. And I agree entirely. Where they see the biggest difference is around not just the quality of borrowers and that kind of stuff, but it's because of underinvestment. We don't have enough houses. And that's a very, very true statement, right? Our builders are not building enough. We already have a deficit of around 4.5 million homes in the US. And we have the largest population group, the millennials, all reaching first-time home buyer age over the next 4 years. This is a big deal. And so supply versus demand, that's what drives residential real estate. And we believe that you know, they're right there. But let's look at the numbers here and how those really look. And so, you know, overall prices are up 8% year over year in September. And so, you know, we continue to keep seeing property values increase. We're glad to see it under double digits. We're glad to see it in single digit price growth kind of thing. We think that that's going to continue to taper off. Some months moving forward, we're going to be flat to 2%.
Some months we may have some negative.
But overall, we're looking at 3 to 4% property value increase over the next year.
Even with a negative, you still have an appreciation.
Yep. So overall, number of home sales fell 25% in September. We know that, you know, they are down. Our total volume is down.
And what happened is some of the incidents are buyer and lender are not communicating, and therefore they don't lock their rates down because what there was quoted prior to may not be the same thing because interest rate has been very volatile.
Yep. So now that being said, seasonally adjusted homes for sale, the total number of homes for sale is up less than 1%. Okay, we're not talking, and when you look at this, is the inventory since 2012. You know, in order to have massive property value depreciation, we would have to have just a huge increase in inventory, supply versus demand. We don't have that right now. You know, new listings are down 22% in September. And so the number of new listings we have coming on the market is so low. I mean, like we haven't seen drops like this since the pandemic. And so folks are just holding off, waiting until the Fed gets done with all that kind of stuff. So time on market came all the way up to 32 days. Okay, that's kind of a little bit of a joke because if you look back at 2015, it was 80 days. You know, we're still in really, really good shape when it comes to that. 32% of our homes still sold over list price in the month of September, which if you look, it's higher than almost every year we've had in there with the exception of 2021.
Correct.
Our average sale to list price ratio, fell to 99%. We're only at 99% of our list price right now, which is really good. We're still at one of the highest numbers. If you take out, you know, the last year, we're still in really good shape. Now we are seeing a lot of price reductions, and part of that's because we have less homes on the market, but also, you know, those folks who just stuck it out there saying, hey, let's just throw this number out there and see what happens.
All right.
You know, the market is kind of taking them and giving them a little shake. Like, nope, you can't just name a price right now. It's going to be about the condition, the quality of the home, that kind of thing.
Absolutely.
So as far as, home buyers that backed out of deals in September, I went ahead and the graph kind of shows, you can see that overall 17% national, 70% of deals fell out in September. Here in Atlanta, much more so, kind of thing. So you can see that last year around this time, 16% of our sales fell apart. This year we're at 25%. Last month we're at 22. I'm sorry. The month before we're at 22. Last month 25. 1 out of 4 of our sales fell apart. We saw the same thing at the brokerage level. We saw a lot of terminations in there.
And some of them are just buyer's remorse, and some of them are interest rate related, and some just have, personal thing that come up. We have one that bought right in the middle transaction and was told that they're not relocating anymore.
Yeah.
So, it just depends.
So, there's still a lot of competition out there. A year ago, about almost 60% of our offers had a lot of competition on it. This year, it's down to about a third. So we are still seeing where competition is a big deal, but it is not the big deal.
Driven.
New home sales, however, boy, that's where we're seeing a real kick in the teeth. New home sales are down significantly, and that's one that concerns us because we know that wealth, and as we showed before, wealth is tied up in home ownership in the United States, and so that's a really big deal for us moving forward. And
it's builders are looking at their inventory right now and trying to figure out, okay, what can we do to incentivize? We're seeing a lot of builder doing a buy down for the buyers and offer incentives just to get the inventory moving as well.
Well, and if you look at that graph right there, since 2007, we have not built enough homes to meet demand. In that 2006, 2007 was the first time that we've done that. So for the last 15 years,
we haven't done it.
We've underbuilt. And so when folks are like, well, I keep waiting on property values to drop, keep waiting, bubby, because it ain't looking like it's going to happen, kind of thing. So this week in training, so I'm here teaching our relaunch classes in our Noonan office. I'm going to be here Monday, Wednesday, Friday. We also have those same, we have lead generation, technology and real estate, and business planning this week virtually as well. So those will be virtual classes, which is also part of our relaunch. And so those are 9:30 every day. So we hope you guys have a great week. If we can be any kind of service, please call, text, smoke signals. We hope you guys have a great week.
Thank you. And have a great Monday. Thanks. And happy Halloween.